The world just got another shock from Washington. A new 100% tariff threat aimed squarely at China has reignited a trade storm many thought was over. Markets fell, headlines screamed trade war, and analysts warned of inflation and shortages. But while the spotlight stayed on the U.S. and China, a quiet winner emerged in the background: Canada. Because when superpowers clash over minerals, technology, and tariffs, supply chains don't disappear, they move. And right now, those routes are redrawing themselves northward. China tightens exports of rare earth elements. Washington raises tariffs in retaliation. But behind that noise, investors, automakers, and miners are quietly reshaping a trillion-dollar supply map, one that suddenly points toward Ontario, Quebec, and Newfoundland. Welcome to Geo Capitalist, where we decode global wealth one quiet power shift at a time. Today's episode: Trump's tariff fight with China just made Canada stronger, and no one saw it coming. Let's follow the money. The escalation began in early October 2025 when President Donald Trump announced plans for a 100% tariff on Chinese goods. His reasoning: China's new restrictions on rare earth exports, 5 critical elements used in semiconductors, defense systems, and electric vehicles. Beijing called it national security. Washington called it manipulation. Either way, it reopened an economic front that had been cooling for years. The proposed tariffs would cover not just electronics and metals, but also EV components and solar equipment, the building blocks of the clean tech race. Analysts on Wall Street called it the second trade shock. The S&P 500 dropped nearly 3% in a day. Commodity traders scrambled for new supply routes. Trump's message was clear: if China wants to play hardball, the U.S. can play harder. But the underlying math is different this time. China still refines over 90% of the world's rare earths. That makes any tariff a tax on dependency itself. For policymakers, it's a weapon of leverage. For corporations, it's a logistics nightmare. And for Canada, it's opportunity disguised as chaos. Because every time Washington raises the cost of importing from China, alternative suppliers gain ground. And Canada has quietly positioned itself as the most credible alternative of all. For decades, the global mining map tilted east. China wasn't just a producer, it was the processor, the refiner, the bottleneck. But Canada's mineral base never went away. It simply stayed dormant under low prices and policy inertia. Now, that bottleneck is breaking. Since 2023, Ottawa has rolled out a $4 billion Canadian critical minerals strategy, funding exploration, refining, and export infrastructure from Labrador to Saskatchewan. The goal: become the democratic world's reliable supplier of rare earth metals, nickel, and cobalt, the ingredients of batteries, turbines, and chips. Europe is already on board. Germany, Portugal, and Japan have signed joint sourcing and technology agreements with Canadian firms to reduce dependence on Chinese refining. Even the United States, despite its rhetoric, depends on Canadian minerals for electric vehicle and defense manufacturing. When China tightens its export tap, Canada's ports and mines become the natural detour. Freight data already show rising container volumes between Atlantic Canada and Europe as energy and mineral flows reroute westward. It's not just about resources, it's about trust. In a world where tariffs and sanctions can change overnight, reliability itself becomes a commodity. And that's the product Canada sells best. While Washington and Beijing trade press releases, the real strategy is unfolding in boardrooms. American corporations are quietly redrawing their supply maps northward. Tesla has begun sourcing battery-grade nickel and lithium from Quebec and Labrador, signing long-term deals with Vale Base Metals and Sigma Lithium. General Motors followed, locking in cobalt supply from Vale and building cathode capacity through its Ultium Cells project in Ontario. Ford Motor Company is partnering with EcoPro BM and SK On, constructing a 1.2 billion Canadian dollars cathode plant in Ontario to protect its EV production from tariff shocks. Even outside the auto sector, the pattern repeats. General Electric is anchoring rare earth magnet work in Nova Scotia, securing turbine components for wind and aerospace. And through suppliers like Umicore Canada and 3M, Apple is integrating Canadian refined metals to meet China-light sourcing rules. Each move may seem tactical, but together they mark a strategic migration. When tariffs raise friction at the Pacific, logistics naturally tilt toward the Atlantic. Canada becomes the predictable partner, politically stable, resource-rich, ESG-compliant. This is friendshoring in motion. Democracies trading with democracies, industries pricing instability over cheap labor. No speeches, no slogans, just contracts. And for every U.S. firm rerouting supply through Toronto, Ontario, or Newfoundland, another $1 billion quietly shifts from China's ledger to Canada's. Tariffs are a blunt instrument. They protect in theory, but distort in practice. For Washington, the new measures risk reigniting inflation just as growth softens. Higher import prices hit consumers, while retaliation from Beijing could squeeze exporters from agriculture to aviation. Farmers face higher fertilizer costs. Airlines pay more for spare parts. Even tech giants see margins eroded by longer lead times. Beijing's counter move is precision-targeted. China has already expanded its export control list, requiring licenses for rare earth technology and refining processes. That slows global production and complicates compliance. Analysts describe it as weaponized paperwork, a bureaucratic drag that feels invisible until factories stop receiving shipments. By mid-2025, customs data show clearance delays for key components stretching from 2 days to 2 weeks. That gap alone can freeze assembly lines and inflate prices across entire industries. In Europe, policymakers are watching the drama with mixed feelings. They support Washington's push for fair competition, but dislike the collateral volatility. Brussels estimates that renewed U.S.-China tension could shave 0.5 percentage point off EU GDP growth in 2025. That's why capitals from Berlin to Lisbon are quietly doubling down on Canadian partnerships to secure critical materials and stabilize supply chains. It's geopolitical insurance through diversification, a practical hedge against unpredictable superpowers. Meanwhile, Southeast Asia and Latin America are positioning as secondary winners, offering mid-tier manufacturing to replace Chinese output. But even there, financing and environmental standards lag behind Canada's, making Ottawa the preferred long-term anchor for advanced economies. For multinationals, the calculus is simple. Tariffs create noise, but supply certainty creates value, and Canada, quietly neutral in the crossfire, offers both credibility and capacity. Its ports are expanding, its export credits are guaranteed, and its political climate remains predictably dull. And investors love dull. Every tariff Washington announces makes Ottawa's minerals more valuable. Every export license Beijing delays makes Canadian ports busier. The global system isn't collapsing, it's rerouting, searching for the fastest path between cost and confidence. And once again, Canada stands exactly at that junction, the calm midpoint of a turbulent century. This realignment is visible in capital flows. Since 2024, more than $12 billion in new investments have poured into Canada's critical minerals and battery sectors. Toronto-listed explorers are seeing valuations climb as demand outpaces output. The result? A rare convergence of environmental, industrial, and geopolitical goals. Canada's pitch is compelling. It offers transparency, renewable power for processing, and access to both Atlantic and Pacific shipping lanes. For investors weary of policy shocks, that combination is priceless. Mark Carney, former central banker turned energy advisor, has become an unofficial ambassador of this strategy, positioning Canada as a stabilizer in a volatile global economy. His message resonates with Europe and Asia alike. Predictability is the new profit. At the ground level, Canadian provinces are racing to supply that predictability. Quebec's mining corridor, Ontario's EV belt, and Newfoundland's port infrastructure are transforming into a continental network. The winners aren't just miners, but engineers, shippers, and tech suppliers who monetize stability itself. In a decade defined by volatility, Canada's calm competence has become its most valuable export, and that quiet confidence is turning into contracts, not headlines. Step back, and the pattern sharpens. The tariff fight isn't just a trade dispute, it's a race to control the inputs of modern power. Batteries, semiconductors, data cables, turbines, each depends on rare materials, and each chain has choke points that define who gets to grow and who waits. China's strategy is depth. Own the refining, processing, and logistics. America's strategy is disruption. Raise costs, impose tariffs, and slow down rivals. Canada's strategy is trust. Make reliability the new premium product. That trust is winning customers. Ottawa's new mineral partnerships with Japan, Portugal, and Germany aren't glamorous photo ops. They're functional supply agreements designed to keep factories running regardless of political shifts or election cycles. They prove that middle powers can quietly reshape the economic architecture of the century without ever making a scene. The geopolitics of the 2020s are less about ideology and more about infrastructure. Pipelines are being replaced by supply corridors. Alliances are being built not through speeches, but through logistics maps, shipping data, and investment guarantees. In this world, credibility is currency malure, and Canada is cashing in. Even Europe's recovery plans, once centered on China's raw materials, are tilting toward North America's north. The European Investment Bank, the Japan Bank for International Cooperation, and Canada's Export Development Corporation are quietly aligning financing models, building what analysts call the democratic supply chain. It's not a headline war, it's a paperwork revolution. While Washington and Beijing debate who's winning the century, Ottawa is selling the blueprints to build it. Each refinery, shipping lane, and port upgrade acts like a signature under the new global contract. The winners aren't those who shout the loudest, but those who deliver quietly, consistently, and profitably. And that, more than tariffs or politics, may prove to be the most strategic move of all. In every power shift, noise hides opportunity. Tariffs grab headlines, but adaptation creates wealth. The 100% tariff threat might sound dramatic, but in reality, it's only accelerating a transformation that was already underway. The rebuilding of the Western supply chain around predictability. China will remain the manufacturing giant. The United States will remain the marketplace of innovation. But Canada, strategically positioned between them, is becoming the logistical conscience of the global economy, the country that turns volatility into order. From nickel mines in Labrador to magnet plants in Nova Scotia, from lithium in Quebec to hydrogen corridors with Europe, Canada's map is lighting up, not because of politics, but because of mathematics. Contracts are multiplying, investment capital is compounding, and confidence is becoming measurable again. Investors understand something politicians often forget. Capital flows to calm waters. And as trade routes fracture and tariffs rise, global industries are searching for ports that don't make headlines, only profits. That's why, for many corporations, Ottawa now represents something rare, a safe harbor in a noisy world. Canada's rise isn't loud, and that's exactly why it's effective. In geopolitics, stability compounds faster than chaos. And while others argue over who lost what, Canada is quietly building the infrastructure of tomorrow. One port, one corridor, one partnership at a time. So, when the next headline screams, "Trade war escalates," remember, markets move faster than politics, and sometimes the country that stays calm ends up strongest. Every tariff, every export ban, every licensing dispute, they all tell the same story. The world's supply lines are being rewritten, and Canada is learning to write in ink, not pencil. In the short term, Washington's tariff threat pressures markets. In the long term, it pressures habits, forcing companies, investors, and governments to rethink where trust really lives. And the quiet answer is appearing on a different horizon, from Labrador's mineral ports to Ontario's battery corridors, from Nova Scotia's magnet plants to Vancouver's clean tech labs. The lesson isn't about tariffs or ideology. It's about resilience as a business model. China built speed. America built scale. Canada is building reliability. And in an uncertain century, reliability compounds like interest. If these trends hold, the next decade won't be defined by who dominates production, but by who anchors confidence. That's why the real power of this tariff fight isn't measured in duties collected. It's measured in trust gained. So while headlines frame it as another U.S.-China standoff, investors quietly see something else. A new corridor of capital, stretching north across the border, where stability is the rarest earth of all. You've been watching Geo Capitalist, where we decode global wealth one quiet power shift at a time. If you found this breakdown valuable, check our next episode. It connects directly to what Canada is building. Like, share, and subscribe. Because the next economic revolution won't be televised. It'll be mapped, port by port, contract by contract, nation by nation. Thanks for watching, and see you next time. When Washington reignited its tariff war with Beijing, most analysts saw disruption. Few noticed the quiet winner emerging behind the noise. Canada. Today, we break down how Trump's 100% tariff threat on China is quietly making Canada stronger. Welcome to Geo Capitalist, where we decode global wealth, one quiet power shift at a time.